Hey, it's Soleil, and this is episode 86 of the Orange Pill Investor. And today I want to talk about, well, I guess I should say, I don't want to talk about how I made like $140,000 trading options my first year and a half. And then in the next 3 months, gave it all back and lost the whole amount. So Robinhood is weird. So I expanded this to all time. So it actually looks like they're saying when I started, they're saying that I had negative $30,000. So that's weird. And that's because the money that I made on this account, I've actually taken out and I moved it over to my Taste Trade account. So looks like total I profited whatever, the $5,000 I got plus the negative 36. So yeah, so about 36 grand more than I started with over 4 years. However, you could see, okay, this was me actively trading, and I didn't start with 75 grand. I had a 401k at my LLC, and I'm like, you know what, screw this. I'm just going to trade this all myself. Guy was getting me into options. And so I'm going to tell this story so that you don't have to repeat these mistakes. Hopefully you can learn from my growing pains. But this was like right after the market shit the bed, and I think maybe my account went down from like 100 and something grand to like 75, and I'm like, I'm getting my money out of here and just wait and see what happens. And so when I started trading, that was when we had the V-shaped recovery, and so everybody's making money here. And so the 75 that I had in here, actually, I guess I made more than 210. Probably made closer to 245. No, I'm sorry, because that doesn't include the 35 grand that I made here. Yeah. So anyway, I had put in like 35 at first. I'm like, all right, because I just wanted to have something that was above the 25K limit so I could day trade. And I knew I was making money, and I was making way more money than the market was making. So if I go and look at what the SPY did from May of 2020 to November 2021, everybody was making money. But yeah, this is the crash. And so then in May, it was 280, and then to November 2021, it kind of peaked around here to 460. So 280, if it was doubled, that would have got to 5 something. So I mean, everybody was making money, but whatever, 460, 280 divided by 460. Where's my calculator? Divided by... Yeah, so people are up like 60%, and I had turned 70 into 210, so I basically tripled my money. So I was doing way better than the market was if I had just stuck my money into the SPY here in May. I would gotten a healthy return and just sat on it and done nothing. But sure, I was killing the market. Nobody was turning. Well, the day traders maybe were, but I was doing a much safer trading here. So had I been doing dangerous trading, I would have even made more money if I was long during this long stretch. But and the whole time I was kind of paranoid because I'm like, I had just started, so I'm like, is it this easy for everybody? And apparently I should have been worried because this is when the Fed basically started raising rates and I had a ton of money in Tesla. I was making a bunch of money in Tesla at that time. So let's get 5 years of Tesla. So boom, that's when it peaked, Tesla, and that's when it just really started going to shit. And I can't remember where the split happened in here, but what really screwed me was, instead of just this whole time I was owning shares and I just traded against shares. And if I had sold covered calls against shares, I would have taken the loss on the value of Tesla, but I would have been making money on the covered calls this whole way down. And then, boohoo, it would have dropped to 25% of what it had been, but 25%, I didn't have everything in Tesla. So, but I would have been making tons and tons of money on the covered calls all the way down. So even though the shares themselves would have lost 75% of the value, I wouldn't have lost 75% of my value because I would have been collecting premium this whole way down. But so that wasn't even what wrecked me. This was not, and I didn't really know about, the macro environment and whatnot. I didn't realize how much that, let's just look at the SPY again. I didn't realize how much the rates were going to kill, tech companies in general. So it killed everybody. So let's look at how this bottomed. So it was like 475, so not quite 500, but then it bottomed out at 360. So people only lost like $110 a share on this, which is like, instead of losing 75% of your value like Tesla did, this only lost, 25% of its value. But the buy and hold people got crushed as well. Everybody was out on a ledge when this was happening, unless you're just totally used to it and you just don't care and you're just DCAing all the way down, I suppose. So everybody made money here to here. I made more than everybody. And then because I had shifted my shares strategy along here somewhere, I was like, you know what? I can make more if I, instead of owning the shares, if I buy leaps, which are long option calls. Goes back to Tesla. So I got the bright idea, instead of paying, like if I was going to do this today, which I do have a few of these now, if I was, instead of paying 16 grand for 100 shares of Tesla, it's called a poor man's covered call. So if you go out here almost a year, and then you go deep in the money to like 0.8, 0.9 delta. But like, let's just say something here. So you can get the $100 strike for half price. And this acts, so the delta here means that for every dollar that the price of Tesla changes, the price of this option will change 89 cents. So you're practically getting all the gains from Tesla when it goes up, but you're only paying half the price. So I was able to sell twice as many covered calls doing this method. So that's one of the reasons why I was like, okay, I'm just printing money over here. And the reason why I was able to destroy a year and a half of progress in 3 months is because this number changes faster when the stock price starts to plummet. So if you own 100 shares of Tesla at $400 a share and it drops to $300 a share, okay, you lost 25%. And if you're a long-term investor, maybe you don't care and you just gut it out and you hold forever. That's perfectly fine. But when you create these synthetic stocks, the value, you would think, oh, okay, well, the value drops by, 90 cents on a dollar. So if the price of Tesla drops $100, you're like, oh, okay, well, my price is going to drop $90. Well, this damn thing's only worth $7,500. So how can it drop 9,000? And this number does change as the value of Tesla changes. based on these other Greeks. So you can see as if we go down here, this price will get closer to 1. Boom. And so then if the price of Tesla crashes on you from 160, this delta is going to get smaller. But like if Tesla was to crash down to 100, basically be at even money, it's, the price is going to drop by half or 75%, even if the price of Tesla only dropped 25%. These long options, because they're worth less, they crash much, much faster. And so that was what is responsible for, in a span of 3 months, November 2021, November, December, January, boom, I lost $146,000 of value because I did not realize that the price of these leaps could crash so much faster than shares. I just didn't have the experience. So I damn sure know it now, and hopefully folks can take that as a warning. It's not financial advice, but definitely try to protect yourself. And so then, at some point I realized, okay, I gotta recalibrate here. So I stopped trading the poor man's covered calls and kind of got back to what I was doing. But my account value was down here so long, and I was kind of shell shocked from it, that you can see that for the most part, from February 22 to 23, I just kind of stagnated. I mean, this just traded, my account kind of just traded sideways, and I was just like, plus I moved most of, some of my trading over to Tasty Trade. And so I was trading some here, kind of out of loyalty to Robinhood, because they had all the low fees back when I was down here and didn't have a lot of money to trade with. I really appreciated being able to keep all that money in my pocket. So I kept trading and just, dicking around a little bit. And then, as you can see, at some point I just stopped trading anything except for Tesla and Bitcoin. And so when Bitcoin started to pick back up, that's when I was able to start making some gains. And so the moral of the story is, don't trade outside of your size, number one. So these leaps and these poor man's covered calls, they're fine, but they should be, even though I'm not diversified as far as stocks themselves go, you should be diversified in your strategies. So something extremely risky like long options, keep that as a percentage of your account that you can afford to lose. Like if I only had 10% of my money right here in long options, then I would have, when this crashed 75%, I would have only lost 75% of 10%, and that wouldn't have been, almost blowing up my entire account. Those types of losses you can stomach. So, as soon as there were rumors that the Fed was going to start hiking rates, I mean, I really should have just picked up on that and said, screw this shit. I'm getting out of something that is affected by the market more. So when the market goes up, Tesla goes up more than the market, and sometimes when the market goes down, Tesla will go down more than the market. So when and I can't remember when the death cross formed, somewhere in here, when the moving averages crossed, and we officially, entered a bear market, that should have really been the initial. At least, if I didn't pick up on the canary in the coal mine before that, at some point when that happened, I should, actually it's probably in the, let's look at the bar chart. So, actually my moving averages might not be quite right, because it should have been around here. Yeah, I don't have these moving averages drawn correctly. But when we hit that death cross, and I don't really even put too much stock in technical analysis, But a golden cross will let you know that you're at least should be in a decent bull market, and a death cross should put you on high alert. And so I should have reversed all of that somewhere in here and just not ridden Tesla all the way down to 100. And even if I was going to ride it down that far, I should have owned the shares so that I didn't have to worry about the price of these long options just collapsing faster than the price of Tesla. And I don't remember how many performance covered calls I was trading at that time, but I was collecting a ton of premium. It just was not, it could not keep up with how fast these leaps were collapsing. So that's my story. You know, I got a little full of myself here. And in the back of my mind, I kind of like, dude, you know, I kind of felt like a fraud because I'm like, if you don't know, well, how's that poker one go? If you don't know who the mark at the table is, it's you. And so I was kind of just accidentally making a bunch of money here. And because what did the guy tell me when I told him what happened? The guy that got me in options, and I told him how much money I lost, and he's just like, oh my God, nobody can lose that much money that fast. But when I told him I was making constructing poor man's covered calls, he was like, well, if you had just held, you know, if you just owned the shares, you wouldn't have gotten wrecked. So he told me I was eggheading it too much, and he was right. So size your positions properly, and to trade options, and that's one reason why people are scared of options. However, I wouldn't have gotten wrecked if I just owned shares and just sold straight up covered calls. Granted, my account would have still gotten hurt by Tesla, but it wouldn't have collapsed as dramatically. So, to me, selling covered call is the safest way to trade. You can make a bunch of money going up. I mean, granted, you might not catch these tippy tops, but it'll also mitigate your losses going down. So to me, covered call it basically just shaves off the tops, and it also shaves off the bottoms. So this would be, you know, less choppy because you're not going to make money above your strikes, so that's when it's going to chop off all these tops, and you're going to mitigate your losses by selling covered calls, so it will make your bottoms higher as well. You'll have higher lows than just the buy and hold crowd. And the only thing that's truly more dangerous in selling covered calls versus just buy and hold is when something goes way high. And the reason why I'm saying that this is the way to trade them safely is because if you own 100 shares, you can't get wrecked, because the worst case scenario is you make profit up to your strike, and then you just have to sell your shares at that price because they're just going to take your shares, and the other guy that owns the call that you sold, he's just going to get your 100 shares, and so that takes away the upside risk. People who sell naked covered calls are taking infinite risk, and as long as you don't do that, to me, selling covered calls is not only the most profitable strategy, but it also is the safest stock market strategy. So with that, I'm going to go ahead, and that's the end of that story. And the TLDR version, I mean, if you listen through this, you don't need the TLDR version, but it's safer to just own the shares, sell covered calls, and don't, screw around creating synthetic stock options that are in excess of your of a position size for your account. So whatever portion you can afford to lose all of, that's the portion that you can assign to leaps, I suppose. So as you can see, the small account challenge is back down to where it was when it got wrecked. What was it, 2 weeks ago? It was back up to $5,000 last week, and then a little to the good, and then all the Bitcoin related stocks are just taking a dump. So as I said before, the down plan is the same as the up plan. We're just going to be reducing our cost basis. And so I'm going to go in here and close this. I hate CLSK in that it only takes increments of $5. Robinhood's pretty cool sometimes though, because that actually gave it to me for 2, so I don't really understand how that works. But let's see. Robinhood's cost basis is $24 an hour, so holy shit, CLSK got wrecked hard. All right, so I don't really worry about my cost. Like, I don't worry about risking selling this below my cost basis. I could check the spreadsheet and see how much premium I collected and see how much my true cost basis is here, but I don't let previous losses get in the way of future gains. So let me just make sure that I'm going to collect at least 10% call away. So from 16 to $1.60, $17.50. So let's go to 18. And that's still collecting about 2% for next week. So let's do that. Collecting 2% ROI for the week, guaranteed, because I just got paid the $30. And then hopefully, I don't know if you can hear my dog whining. It's like an hour before he's supposed to eat, but he's already hungry. So, dude, trying to make a video here. It's not time for you to eat yet. All right, so CLSK is done. Booked 2% profit on that. Let's do HUT. Close it for $1, whatever. There we go. Y'all options. Sell next week. All right, so 10% call away would probably get us to $10. Let's sell this one. And that is about 3% ROI on the premium. If this fills, I might have to go down to 26. With 10% call away value, let's just go to 26. Ain't nobody got time. Sitting around waiting for these. God, that dog. He's got the most annoying whine. Sometimes he sounds like a friggin' pigeon. All right, let me refresh this. I thought I just did Riot. Or do I have two? Do I have 200 shares of Riot? No, I have 700 shares of Riot. Why? What did I just do? I was in a hurry. I did HUT. Oh, I did I just do Mara? All right, I must have just closed Mara. I thought I was closing something else. All right, so let's sell Mara for next week. 10% call away is about $2. So that's about 21, which is a little bit of, let's do 20.5. Let's see if we can get that to fill. Count to 10. All right, let's do this. Let's go to 26, or is that 51? Here we go. You can try to milk $1 out of these if you got time, but I have other things to do. All right, so let's close Riot for $1. And let's sell next week. Uh, 10% call away would be about $1, so let's go to 11.50. collect about 1.5% for the week, and leave 10% call away value in case we get a bounce. All right, so I've got shares of Hut, CLSK, Riot, and Mara. And I've got 412, CLSK, Hut, Riot, and Mara. Now, generally, I'll take the premium and buy some MicroStrategy. But earlier in the week when it had dipped, I had actually already bought, let me check my history. Yeah, so April 2nd, I went ahead and bought like 0.067 shares with $100 worth of MicroStrategy on the 2nd, and the price was $14.82. So I went ahead and kind of bought my $100 worth of MicroStrategy already this week. I snuck that in there on the dip. So that was not a bad little DCA right there. So that's how it's done, and that's how quick and easy it is. And of course, I would prefer if this was going to the moon immediately, but the short term just doesn't matter as long as your long term thesis, I guess, holds. And so, you know, my basic assumption is that Bitcoin and Tesla are going up for the next decade or 2 or 10. And so I don't really worry about too much about short term. But, you know, losing 25% in a couple of weeks is an annoying setback. But like I said, I don't let it stop me from making money. So I just booked another $100 worth of premium or whatever this I'll add it up to. I'll put it into the spreadsheet. But you know, some people, it's called bag holding. So let's just look at CLSK, because I think that one shit the bed the biggest. So my average cost over here is 23 where I bought in, and now it's lost, what, a third of its value. So some people would be scared to sell below that $23, and going out a week, you can't get much. You can't get anything here. So then you're like, oh, well, then I have to roll it out farther. So now I'm at 49 days to get to $24. Okay, I can get $1.45, you know, if I go out 45 days. But now I'm not collecting weekly money. So $1.45 going out 7 weeks is what, 20 a week? What did I just sell this for? So I sold the 18 for 33. Now, if the price does go to 24, then yeah, I just screwed myself out of $500. But I'd rather collect $30 a week for 7 weeks and collect $210 than go out 7 weeks because I'm scared to sell below my cost basis and only earn $145 in 7 weeks. So that's the way that I look at it, and I don't bag hold. I just pretend that this is the price I paid. That's how I look at it. If I didn't want to lose 30% of my value, then I shouldn't have bought a stock before it crashed. That's just the bottom line. So, but you can't. If you want to make money in the stock market, you actually have to own things. So you don't know. I mean, this could have gone to 50. So buying here and it going to 50, you'd look like a genius. But really, you just have no idea what this stock is going to do at any given moment. So that's why I don't try to figure it out. I don't play the revenge game and try to get back. Like, oh, I lost some money here. I gotta do something. I'm desperate to try to like cover those losses or whatever. Long term, as long as you don't pick a stock that goes bankrupt, just goes to zero, selling covered calls against it is a long-term successful strategy for me. Just don't YOLO into leaps, and everything should work out. All right, I think that's a good place to leave it, and hopefully folks can learn from that And all right, be good, y'all.